What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 27th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to break down the breaking announcement from the Federal Reserve from its recent FOMC meeting on what changes it plans to make towards monetary policy, and talk about whether or not this announcement is generally a good sign or bad sign for Bitcoin as well as cryptocurrency markets as a whole. We're going to be diving into all of it. I'm going to be sharing my candid take as we've been trying to analyze what the Fed is going to do. And outside of that as well, if you guys like this video and find it informative, consider subscribing to the channel, dropping a like, and if you haven't already, hit that bell icon so it makes sure that you guys get notified on all uploads here on the channel during these really exciting times. Without further ado, let's go ahead and dive straight into it, guys. We got a lot to uncover. So I want to start off by just focusing first on what the Fed did. What did the Fed decide during the FOMC meeting yesterday? Well, as with all meetings, you generally have kind of two phases. First off, you have a general kind of almost press release or announcement from the Federal Reserve of what major changes they're going to make that comes out a couple minutes before Jerome Powell, or Jay Powell for short, who is the chairman of the Fed, comes out and speaks and answers questions from a variety of reporters. What they generally went out and stated here today is that effective as of this month, there are no changes. Exactly like we talked about in the previous video. This month here in January, going into February, there are no adjustments to monetary policy. They are still engaging in the same exact programs they've been engaging in their bond buying programs, and outside of that as well, they are continuing to maintain interest rates at current levels. A prediction we made in the previous few videos that the Fed was not going to hike rates this month, like many started to bet that the Fed would do. Now, on the other hand, they did make some verbal commitments, as the Fed is very famous for, in a sense, or familiar of. So what did the Fed commit to? The Fed committed to two key things. The first one that everyone is really focused on and talking about as a supposed measure to hopefully effectively curb inflationary pressures in the economy is to bump up interest rates, to start initiating the first interest rate hike, not here in January or February, but in the month of March. So that's not too far away. And this is, again, a form of quantitative tightening that would probably start to hamper assets, or at least the growth potential of assets going into the next coming years. So that's the first thing from the Federal Reserve that they stated. Another thing that people haven't been focusing on as much as the interest rates is the commitment towards building some kind of game plan, announcing some kind of plan to reduce the balance sheet of the Federal Reserve. So over the past couple of years, especially since the pandemic, we have seen parabolic growth in the balance sheet of the Federal Reserve, as well as other central banks like the European Central Bank, the Bank of Japan, you name it. Practically every central bank has played a role in this. And what they've been doing is going out and basically buying up financial assets like bonds, toxic assets like mortgage-backed securities, anything they can get their hands on to put new cash in the balance sheets of commercial banks so that you in fact have the ability to lend out, create more credit in the economy, which unfortunately most of which has gone towards asset markets. At least that's what it seems like in the way that assets have reacted, right? So they're now talking about tightening this, right? Reducing it, meaning that they're going to start unloading, if they're committing to their actual word, they would start to sell bonds, fixed income assets, and that's going to remove free cash from the economy and in effect put more assets on the market, right? So this is generally not a bullish thing for asset markets. Now, I want to go ahead and step back on one really critical point, and I bet, I know a lot of you guys are really wise out there and stuff. You guys got street smarts, and that's really what you need in finance. And I gotta say, I'm not the smartest, I'm not the smartest tool in the shed, but I'll tell you one thing I know for certain is I've got the street smarts to realize that someone can say something and do another. All right, and that is exactly what the Fed has been doing for the past couple years. On Twitter, I tweeted out last night a tweet that I was really eager to put out here, and it's something that just keeps going through my head every single time I hear people getting worried about what the Fed is going to do. I have watched, when I traded equity markets over the past decade, when I got into trading cryptocurrency assets back in 2016, 2017, it became apparent and clear to me that the Federal Reserve as an organization is walking a very thin tightrope. It wants to make sure to keep asset markets propped up. It doesn't want to disappoint asset markets and put us into an asset-based recession. And at the same time, it doesn't want to cause any major economic harm, right? So in general, we can see here that the Fed will say one thing and do another. It'll say one thing to please asset markets, right? Or actually, in this case, to please the economy, in this case, the real world economy, that we are going to be making adjustments to taper inflation, right? That's one of the key problems the Fed didn't have a couple years ago, and it is going to have to address at some point. But at the same time, it doesn't want to disappoint the asset markets, so that when these meetings come out, it actually turns out that the Fed's not actually doing anything this month, right? Now, if you talk, to any of the major global economists, if you talk to any of the people who are analyzing what the Fed is doing, most people are growingly confident that in March we might see this rate hike. And I'm not going to sit here and deny that that could happen, but it was very clear here, first and foremost. And if we go back in the previous meetings, there was pretty clear signs that the Fed was going to do something this month. Everyone was walking in so confidently to it. And what do you know? The Federal Reserve does nothing. It sticks to continuing the same regiment that's been going on time and time again. Now, it's not to say that the confidence level isn't going to grow over time, right? As inflationary pressures start to get up towards double-digit territory, like they were back during the Paul Volcker era back in the 80s in the economy, that is probably when the Federal Reserve is either going to flip the switch, much more heavier than what the Fed is saying as it is going to do right now, right? Probably much more heightened than what they're claiming. And outside of that as well, we're going to see the actual reduction of the balance sheet. And that will probably put us into some kind of recession. But we've been on the idea that this is probably going to be much further delayed than people are claiming, probably in 2023, right? And this is, again, a very important point to keep in mind. So let's just go ahead and take a look, whether you guys agree or disagree with me, let's go ahead and take a look at how the market reacted from the FOMC meeting. Well, depending on whether or not you're trying to take when Jay Powell was talking, or for example, when the first major announcement came out, either way, now again, I will generally say here that if I'm looking at the charts, and we're looking at the hourly chart here for Bitcoin, Bitcoin's charting right where it was here at the same time 2 days ago, right? It's down here, right back around $36,500 range. A little bit of a pullback here from the initial announcement, to be fair. If we're going to say one side or the other, it's generally down, right? And we can see here when the volatility started to pick up, maybe we can get a little bit more closer here, right? The trading started to hit in after the first major announcement, and we're down, generally speaking, about 4% for Bitcoin. Nothing in the sense of the comparison of what we've seen here. If we take a look at the daily chart, markets are pretty neutral here. Nothing too crazy. Well, let's go ahead and take a look at ETH USD. ETH had a little bit of a sharper dip, but again, important to note here, right back where it is on the 25th, right, just 2 days ago, it basically was fading some of the gains going into the excitement around the Fed announcement, right? So again, a couple percentage point decline here from the official announcement. If you want to be official about it, that's totally fine. But again, take a look here at the daily. Not too much change. Pretty much sideways since the actual consolidation here. When a lot of people are talking about this element of something being priced in, it's important to note, guys, that this fear, I think, of the Federal Reserve starting to rise interest rates or restrict quantitative easing and now go towards quantitative tightening, reducing the balance sheet, this has been the pricing in of that event. The correction we've had here for the past couple of months. And we saw here that the Fed isn't even willing to start that program here and now. Why is that? Why can't we do it now, right? And I think that the key point here we need to realize is, again, the Fed, as I've talked about before, will say one thing and do another. They have to walk this tightrope between the real physical economy where credit and loans and circulation of economic activity leads to GDP, right? The Fed wants that. I think at the end of the day, I think we all want to see the economy not enter into a recession. No one wants to be responsible for that. At the same time, pleasing the needs of asset markets, which is easy money, propping up asset values. That's exactly what's been going on for the last decade. Whether you like it or not, that's how the world has worked, right? So again, my case in all of this is that, again, the Fed has been saying one thing and doing another, and I don't think at this point there's really any concern here with the way markets have reacted. And that's a really good sign for crypto assets. Now, one really important question, and I'm always open to different viewpoints, and I think probably one of the questions that still needs to be answered, and I'll be honest, I don't have an absolute direct answer for this, But something that a lot of people brought up in the Dash Report discussion group, I like to engage from time to time and stuff with the community we have there. The Dash Report's the newsletter we do here on the channel. If you guys are interested, you can check the link down below in the description. But I digress on it. We have a really good community there, and a couple of people brought up a really interesting point that I wanted to answer to, which is, okay, Nick, so the Federal Reserve hasn't engaged in the kind of monetary policy they probably claimed they were going to in the past, right? They've taken a slower process to this. But let's be real, right? If we are going to be entering into some form of monetary policy contraction or tightening, and it's going to be, there's not going to be any more excessive printing of money like we saw since back in March of 2020, since the pandemic started, and we had our pullback back then about a little over a year and a half ago. And we're also not seeing any further decline in interest rates. We're near rock bottom and only probably going up from here. What's the reason for crypto markets or assets as a whole to move up? And that's a very fair question. I don't think there's an absolute clear answer just yet, but I do want to propose one important thing that we need to face. There is a reason we are seeing inflation in the economy right now. It is because over the past couple of years, we have hyper expanded the amount of cash in the economy. And I'm not just talking about dollars. We need to go global. We need to consider euros. We need to consider Japanese yen. We need to consider the entire currency apparatus of the world. And I want to go ahead and just show this through a chart here. Let me see if I got it up here. The total assets of the major central banks of the world. If you want to measure it in dollar value, the central banks of the world have effectively taken us from a moment where we had around $19-20 trillion back here in 2020 when we were just starting to contract the global money supply. Pandemic hits, cause for monetary easing starts to kick in, and we go from $20 trillion of cash, right, injected into the economy throughout the rest of history, now up to 31 trillion, a 50% increase in the base monetary supply. Now, the growth rate is declining here. We see the ECB starting to taper off a little bit. Fed still charging ahead, still has some room against Europe here. The Bank of Japan starting to cool down since as far back as the end of 2020, right? China slowly starting to taper up here with the People's Bank of China increasing a lot less than other partners across the world. Even though we're seeing the growth rate decline here, does it mean that the game is over for assets? Is the gig up, right? Well, why are we seeing inflation in the economy? We're seeing inflation because we're still seeing the ramifications of this new printing of money in the economy. There is an important delay, and this is something that I think that people need to understand, which is that markets are never 100% effective, right? So people think, for example, when you increase the base monetary supply 50%, everything's just going to correct back to that value immediately. And that's actually not the case. I'll go ahead and actually show that through a chart here. We can take a look here at the S&P 500 divided by the M2 supply, right? This is the M2 supply, the money supply. It's a measurement of taking the broad range of measuring the amount of cash or money within the economy. Basically tracks here, in this case, the expansion of the money supply. And what would you know here? Taking a look here at the long-term chart, maybe we can break it down here to the weekly to really kind of make it apparent, right? Even though stocks might be chartering to new all-time highs, and the Nasdaq and the S&P 500 and a lot of these major indices, what you find here is that what we really are just doing, and what we did back here into January 2022, right? Nearly 2 years later, we just got back up to where we were back here in January 2020 before the pandemic and the correction, the bear market that we went through, right? We just got back up to square one. And now we're starting to see a little bit of a pullback in the market, right? Something similar to what we saw many times in the past. Now, I think here what we need to watch, and this answers the question here for crypto as we go through this conversation, but there's some more things we got to dive into. We can see here whether or not the S&P 500 against the M2 money supply, if it's going to repeat what it had back here between the early 2000s to here in 2007 before the housing crisis, right? We see here that there's an expansion of highs here in the S&P 500 against the money supply. It's a ratio we're looking at here. And if we can't start to hold up at this range here, the similar discount range we've had back in the past, and start to get up above here within 2022, above this range to showcase that the market wants more, right? We've seen that we've been at heightened levels higher than we are before against the base money supply, right? Then that's going to spell problems for the asset space. Right, and this is a big thing that I do want to encourage everyone starts to focus on here. French Chaparro from the block put out a really interesting comparative chart where it takes a look at the Nasdaq composite and its correlation to Bitcoin as an asset. There isn't always been a clear connection between the two assets, but as cryptocurrency markets have been getting to be more of a consolidative asset where we have these heightened rallies that we've talked about on the channel, and then they push sideways for a while as an asset, we can see here that correlation to the Nasdaq here over the past month or so, right, has started to grow at a heightened level. A little over here, around an 80% correlation, pressing towards an 85% correlation to the Nasdaq. Meaning that if the Nasdaq is moving up, let's say, for example, maybe 1%, right? Again, it could be that Bitcoin is maybe still moving more than the Nasdaq upwards in this case, or vice versa. The Nasdaq goes down 1%, Bitcoin drops 2 or 3%. Either way, there is a correlation in the direction of these two assets, meaning that they have a similar direction, either going upwards or downwards in price. And you can see here that it's got a much higher correlation than the one that it's commonly referenced to, which is gold, right? In fact, it has a negative correlation against gold. So what we can see here is whatever is going to happen in asset markets as a whole is probably going to drive Bitcoin forward, right? Now, one important thing I think that's important to keep in mind here, right? Outside of taking a look at the long-term charts here for the Nasdaq or taking a look here at the short-term, then we've got the Nasdaq 100. This is showcasing even the futures where, again, we've just been chopping sideways well before the FOMC meeting, right? So it seems so far that things are priced in. We got to wait for more direction in the market. But one thing that's important to keep in mind on the macro perspective is that even though the Fed balance sheet, again, and this is an important part about the delayed effect of injecting new money into the economy, even though the Federal Reserve has stopped, in this case, the new printing of new money, we still need to see if there are generally more inflows or outflows, because that's what's going to determine asset prices. And one thing that I think we haven't talked about for a good while here on the channel, we used to talk about a lot during 2018, 2019, and 2020, is the corporate buybacks. So what are corporate buybacks? Corporate buybacks, or stock buybacks, are a program where companies can take their quarterly earnings that they make from their business operations, and they may choose to go out and purchase more shares of their company, extracting or contracting the available supply of shares on the market. And effectively, as you limit supply, price tends to go up, right? So this is a way, again, where companies will utilize excess cash on their balance sheet outside of just paying dividends or putting it into a company treasury. They'll actually go out and engage in repurchasing shares of their company. And we can see here that the 4-week rolling average here, this is measured in millions, so we're talking about billions of dollars here off of the effective y-axis, right? Over $3 billion in 4-week average buybacks into shares in publicly traded companies. Another way to view this, again, the corporate client buybacks are leading on the S&P 500 at record levels here in the sense of the growth of the 4-week average, right? We can see here a major spike up here in share buybacks. And if you just want to view this in probably the most simple way, right, take a look at the pure dollar value. U.S. share buybacks in 2021 reached a new record high of $1.234 trillion. If the Fed can't keep stocks up, the immense amount of pile of money that they are not going to be contracting to any large degree anytime soon certainly might. And that's an important thing to keep in mind here, guys, is that we got to step out into the macro perspective. And I think this is one area, and it's with all due respect, there's a lot of great other content creators out there on YouTube, guys. But one thing I always I'm thankful for is I have my background in equities, trading in equity markets, learning about how monetary policy and inflows and outflows will dictate whether or not asset markets move up or down. It's a really simple game once you start to understand it. And we can see here During this time period, if you'll notice, you can see that after 2018, we had a decline here in stock buybacks, and asset markets followed suit, right? Even though we had a couple catalysts, we saw that there was a decline in new capital in the economy. And since 2021, right, since the economy has started to come back, we've started to see more money injected in the system. We can see here that stock buybacks are at new all-time highs. Now, again, considering the debasement of money in this case, that might be an important thing to factor in as well. Nonetheless, though, when we're talking about asset prices, again, it explains why, in dollar terms here, we've been continuing to rally upwards here. And after a discount like what we've seen here in the market and assets, from the Nasdaq to the Russell 2000, we're already down 20% from the highs here for the Russell 2000. I think that if anything, we've got little correction territory left here for the asset markets until the Fed actually does something, until the Fed actually makes any significant moves and stops talking the talk but starts walking the walk. I have no reason to divest myself from assets, especially on a discount, right? And with so much money still in the system that needs to be put somewhere, the $10 trillion in deposit accounts that people have in America sitting in a bank account earning nothing, the other 8 to 10 trillion in European markets. You've got so much wealth in the world right now, so much cash in the system that just simply doesn't have a home right now. And in fact, is being penalized by the inflation we're seeing in the economy. The failure of central banks to be able to actually drive the physical economy, but rather asset markets. Fool me once, shame on you. Fool me dozens of times over the last decade. Well, I guess there's no one else to blame other than myself, right? And that's exactly what the Federal Reserve has been doing, guys. So case in point here, I don't want to ramble on too long, but I think the roadmap here for Bitcoin and cryptocurrencies, not only on a macro perspective in the sense of markets of scale, considering Bitcoin is a $650 billion asset. You take gold, that's $12-13 trillion asset class. You've got global equities at I think it's $125 trillion in global value. I know that I'm feeling comfortable, even though it's more volatile in the short term. I feel more comfortable in cryptocurrency assets. And when we think about the growth perspective long term, you got people like Cathie Wood coming out and making, again, just like how people claim Bitcoin reached 10K or 20K back a couple years ago, how bold that sounded, how crazy it sounded, coming out and making claims that Bitcoin could reach up to $1 million per coin, $21 trillion fully diluted market cap. Could it be possible? Well, Bitcoin as an asset could be used for a variety of different things, right? And we're talking about a long time preference, 2030, right? Almost the whole entire decade here in this case, 8 years that we still have to go here before we would get to these kind of target dates. And the use cases here are quite interesting. I'll make sure I can zoom out. You guys can dive into the report if you guys would like. It's free and accessible online. But case in point, I think that right now is not the time to panic by any regards. I haven't made any adjustments since last night during the Fed news. And I think what we need to do here is we need to continue to keep vigilant on the idea that until there is actual action by the Fed, until there's something more than talk, the asset game is going to keep going. The punch bowl is still being filled right now. Interest rates, even if they start to rise, are at very minute degrees of increases in the future. They're not increasing now. There's no reason to panic. But to have yourself prepared, having some cash on side, or again, making sure you've got stops set and know when the music is stopping, so long as you know what to look for, then everything's all good. Now, one thing that I hear from a lot of you guys out there when it comes to crypto, and many of you who are really starting to invest substantial amounts in crypto, one of the big things that I constantly hear from people is around security of their assets. And one of the big names that I've been a big fan of here on the channel, which is our sponsor for today's video, is Ledger. Ledger is one of the hardware wallet solutions out there on the market. So I want to spend some time, though, to talk about how you can not only have the key security that you used to having with Ledger, but also some new convenience in the way that you can actually spend your crypto. Let's go ahead and hop into it. Now, if you haven't heard the announcement just yet, Ledger, one of the largest hardware wallet solution companies in the crypto space, in partnership with banks, another major reputable name in crypto, have teamed together to provide a new crypto debit card known as the CL card. Now, many of you might know about Ledger for its hardware wallet solutions. I personally use Ledger to store some of my funds in the crypto space, and I know many of you out there as well might do the same. But one of the big setbacks or problems that can come with hardware wallets is all the while they're a great solution to secure your funds, one of the best in the market. The problem is when you want to actually go about spending your crypto. Because if you want to, you usually have to send it from your Ledger wallet towards your crypto exchange account and then back to your bank account, only then being able to spend from your debit card. Well, that's where the CL card starts to change things. You can have all the same time-tested security of cold wallet security for your funds by leaving the vast majority within your Ledger device, and by simply topping up a small amount into your card account within the Ledger Live app, you're able to conveniently spend some of your crypto within the real world at thousands of different merchants through the Visa network. So if you guys are interested in this, I highly recommend diving more into this partnership between Ledger and banks by signing up here on the wait list if you're eager to get a test of the product early on and get your hands on it. And if you guys are curious to learn a little bit more about Ledger as a company, if you don't already own a hardware wallet, I highly recommend going over to the website and learning more about it. Ledger is a key provider. We've talked about them here on the channel many times. And again, I've really had a good time using the hardware wallet device that they've provided. So I'm really excited to see what can happen here now with the CL card and how it'll make spending crypto in the real world a lot more convenient. Anyways, guys, I hope you guys are interested in the CL card, but I digress. If you enjoyed this video, guys, consider dropping a like, consider subscribing, hitting that bell icon. And if you guys love this kind of macro analysis, if you love what we're talking about here on the channel, you guys can always check out the Dash report. We really try to focus on giving a macro perspective on what's coming up here in the market, trying to track what the Fed is doing, trying to understand what asset markets are going to do in the long run, and trying to pick out some really key investments in the space. I share my recommendations, or in this case, plays that I'm watching in the market when it comes to cryptocurrencies, to equities and everything. And all the while, it's not direct financial advice. It's the things that I'm watching in the market and a really nice, concise newsletter that we try to make as affordable as possible. So if you guys are interested, check out the link down below in the description. If you listen to me ramble on long enough, you guys deserve a gold star. And I hope you guys found value in the video. That being said, everyone, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.